If you've been holding your breath waiting for interest rates to finally drop so you can buy a house or pay off that lingering debt, you might want to exhale. The entire financial world just quietly threw in the towel on the idea of rate cuts for 2026.
Wall Street is actually bracing for something much worse. That whole optimistic dream we had about inflation being totally conquered, yeah, it's officially collapsed. Investors looking at the data have completely priced out any hope of a rate cut this year. It means we are locked into a painful, higher-for-longer reality. The era of cheap money is dead, and honestly, your everyday budget is caught right in the crosshairs of a massive macroeconomic breakdown, one that actually started thousands of miles away. See, right now, a severe geopolitical crisis has completely choked off the Strait of Hormuz. That is the world's most critical maritime choke point. Practically overnight, over 14 million barrels of oil and 20% of global liquefied natural gas vanished from the market. It shattered the Federal Reserve's playbook. We went from a January baseline of around $60 a barrel, skyrocketing to a staggering peak of over $116 by March. And even with global superpowers dumping their emergency inventories, commercial stockpiles on land are draining at a terrifying pace. But the sheer scale of the worst-case scenario, that's what's truly alarming. Energy consulting firms are warning that if this extended blockade drags on through the end of 2026, Brent crude could absolutely explode toward $200 a barrel. Think about that for a second. A closed shipping lane on the other side of the planet literally changes the price of food at your local grocery store because upstream shipping and fertilizer costs just go through the roof. It's the kind of massive supply shock that could literally shrink global GDP. But it gets even trickier because the response to this crisis is deeply, deeply divided. What we're witnessing right now is essentially a high-stakes game of chicken between Washington's trillion-dollar spending habits and a fractured Federal Reserve. You've got one side pumping massive stimulus into the economy, hitting the gas, while the other side is desperately trying to slam on the brakes. The contradiction is just wild. The Fed wants to keep borrowing costs high to crush demand and cool down inflation, but domestic fiscal policy is doing the exact opposite. That massive stimulus really took shape when the One Big Beautiful Bill Act was signed into law, extending major tax cuts and throwing in sweeping new deductions. Now, sure, in the short term, this huge fiscal injection boosts consumer spending, it props up GDP. But here's the catch. Because of these changes, the federal deficit is projected to balloon by an additional $5.1 trillion over the next 10 years. And major economic models are flashing red, warning that long-term, these massive deficits are going to absorb national savings, crowd out private investment, and essentially force the Fed into a corner where they absolutely have to keep interest rates sky high just to stop an inflationary spiral. And caught right in the middle of this trillion-dollar fiscal fire is the Federal Reserve itself. They just went through their most divisive leadership change since 1992. The new chair, Kevin Warsh, inherited an internal committee that is completely fractured. You can see it clear as day in the latest voting breakdown, 8 votes to keep rates steady against 4 dissenting voices pushing in totally different directions. Multiple regional presidents are actively trying to strip away any bias toward lowering rates. They want to send a loud message that future rate hikes are now just as likely as cuts. So, the central bank is basically fighting an internal civil war over how to handle an inflation spike driven by energy costs. Richmond Fed President Tom Barkin actually summed up the hesitation perfectly. He pointed out that raising interest rates to kill consumer demand is a pretty broken way to fix a supply shock. I mean, you wouldn't try to solve an egg shortage caused by bird flu by intentionally slowing down demand across the entire economy, right? It just doesn't make sense. Yet, hawkish members are terrified that letting inflation run hot will permanently infect everything else. All this friction means monetary policy is right now essentially flying blind. So what does this all mean for you? How does this massive economic tug-of-war actually filter down into your personal bank account? Well, the bond market has reacted violently. The critical 10-year Treasury note, which is the benchmark that dictates your mortgages and consumer loans, has climbed to a bruising 4.68%. Make no mistake, the financial walls are rapidly closing in on the everyday consumer. It's creating a severe, inescapable ground-level squeeze. Just look at credit cards. For everyday cardholders, borrowing costs have hit absolute crisis levels. The average interest rate on a variable commercial bank card has shot up to a staggering 19.57%. That is wild. If you're carrying revolving debt right now, you are facing a historically high interest burden that is literally draining your wealth every single month. It's gotten so bad that major institutions like JP Morgan are officially sounding the alarm about rising credit card defaults, especially among lower-income households. And it's not just plastic. Car buyers are staring down average interest rates on new vehicle loans hitting 9.45%. That pushes the typical monthly new car payment to a record-breaking $757. Just imagine writing a $757 check every single month just to keep a standard commuter car in your driveway. At the exact same time, mortgage rates have surged back near 7%. It's building this massive affordability wall that is completely locking everyday people out of the housing market.
Yet while the everyday consumer is getting crushed, the stock market is telling this totally different, deeply divided story. Despite these brutal interest rates, the S&P 500 recently pulled off its longest winning streak since late 2023. But you have to look under the hood. Global energy giants and major banks? They are raking in massive profits, win after win. But tech giants, those high-growth companies that desperately rely on cheap money to fund their future, are suddenly hitting a brick wall. We're talking tech behemoths like Microsoft dropping 23% in the first quarter alone. Investors are suddenly waking up to a really harsh reality. The eye-watering costs required to build out massive artificial intelligence infrastructure are becoming incredibly dangerous when borrowing costs are this high. Add in a global supply shortage in memory chips pushing up hardware costs, and you've got a whole new layer of structural inflation. It forces us to ask a huge question. If the ultimate growth engines of our economy are losing steam under the weight of these greats, where on earth does the financial system go from here? The market is finally waking up to the ultimate macroeconomic trap. If Washington's massive tax extensions stay in place, that structural deficit is going to keep absorbing national savings. That keeps long-term bond yields high and permanently caps how low the Fed can ever cut rates in the future. The entire financial system is trapped between a stalling economy and uncomfortably high inflation. It proves a brutal point. You simply can't borrow your way out of a deficit, and you definitely can't print your way out of an energy crisis. The era of low borrowing costs is over, and navigating your financial life in this high-rate environment is going to take some serious discipline. So, looking at everything we just went through, if the era of cheap money is permanently over, how are you restructuring your personal balance sheet to survive this higher-for-longer reality? Let me know your plan in the comment section below, because surviving this squeeze is going to take all of us paying very, very close attention.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.